How to find an undervalued stock? An undervalued stock is the one whose market price is lower than its intrinsic value and has promising growth potential. They might be undervalued for reasons like market crash, low recognition, or sometimes because of bad press. Here are few metrics which we can look for in order to identify these gems in the stock market for long-term investing. 1. Price to earnings ratio, PA. PA ratio is the most popular and favored metric amongst value investors. This ratio tells us how much the market is willing to pay compared to a company's earnings. It is calculated by dividing market price per share, MPS, by earning per share, EPS, of a company. Formula: PA ratio equals market price per share, earnings per share. A high PA indicates that the stock is expensive or overvalued, whereas a low PA indicates that the stock is low priced or undervalued. It is important that you compare a stock with its industry peers to determine if it's overvalued or undervalued. Let's understand this with an example. Stock A has a market price of 50 rupees and is earning 40 rupees per share. The PA for stock A would be 1.25, 50/40ths. Then, we have stock B whose market price is 20 rupees and is earning Rs. 25 per share. Thus, the PA for stock B would be 0.8, 20/25ths. So, in our first case you are paying 50 rupees to earn profit of 40 rupees, whereas in second case you are only paying 20 rupees to earn profit of Rs. 25. What does this tell us? Yes, you're right. We need to look for lower PA to identify an undervalued stock, which is stock B with 0.8 PA from our example. 2. Price earnings to growth ratio, PEG. PEG ratio takes PA ratio little further by adding expected earnings growth rate in the equation. Hence, PEG is forward-looking. It is calculated by dividing PA ratio by EPS growth of a stock. Formula: PEG ratio equals PA ratio, EPS growth rate. Just like PA, a high PEG indicates overvaluation and a low PEG indicates undervaluation. A company with low PEG ratio and strong earnings growth could prove to be promising. As a rule of thumb, a stock with PEG above 1 is considered to be overvalued and a stock with PEG below 1 is considered to be undervalued. Let's take our previous example ahead to understand this. Stock A has a PA ratio of 1.25 and stock B has a PA ratio of 0.8. Say stock A has an EPS growth rate of 10% and stock B has 12% EPS growth rate. The PEG for stock A would be 0.125, 1.25, 10, whereas that for stock B would be 0.067, 0.8, 12. Hence, stock B wins again. 3. Price to book ratio, PB. The price to book ratio compares a company's market value to its book value. It is calculated by dividing market price per share by book value per share. It measures how much investors are willing to pay for each rupee of a company's net value. Book value is the net asset value of a company which its shareholders would receive in case of liquidation. Book value per share is calculated by dividing equity share capital less preferred stock by number of equity shareholders. Formula: P/B ratio equals market price per share, book value per share. Just like the previous two ratios, this ratio also reflects a high P/B ratio is overvaluation and low P/B is undervaluation. Let's continue with same example from before to understand this. Stock A has a market price per share of 50 rupees and let's say its book value is 30 rupees. So, the P/B for stock A would be 1.67, 50/30ths. Stock B has a market price per share of Rs. 20 whereas its book value is 22 rupees per share. So, the P/B for stock B would be 0.9, 20 seconds, and here we have a winner. 4. Dividend yield ratio. If you're looking for long-term investment and wealth creation, then obviously you would be interested in knowing how much dividends a company is paying to its shareholders. This is when dividend yield ratio comes into picture. This ratio measures the amount paid by a company as dividends to its shareholders compared to its market price. It is calculated by dividing dividend per share by market price per share. Formula. Dividend yield ratio equals dividend per share, market price per share, *100. A dividend-paying company is always in the good books of investors because these companies reflect good financial position, enabling them to share their profits with us. Higher dividend yield is always favorable, however, it is important to compare it with the industry average and its peers. Let's say company A and B are both paying a dividend of 10 rupees per share. But the market price for company A is Rs. 50 whereas for company B it is 30 rupees per share. Hence, the dividend yield of company A is 20%, 10/50ths, *100, and that of company B is 33.34%, 10/30ths, *100. So, by paying only 30 rupees for a stock of company B, I can get 33.34% dividend yield compared to the 20% dividend yield on paying 50 rupees. This is the reason why investing in an undervalued stock can be fruitful in long run. 5. Debt to equity ratio, DE. This ratio is a simple measure of how much debt you use compared to your own funds to run your business. It is calculated by dividing a company's total liabilities by shareholders' equity. Formula. DA ratio equals total debt, shareholders' equity. If a company's DA ratio is too high, it may be a sign of financial distress and reliance on heavy debt to run your daily business activities. But if it's too low, it's a sign that your company is over-relying on equity to finance your business. Hence, it is important that a company manages to strike a good balance between the two whilst keeping its books intact. It would be reasonable to compare a company's DA ratio with its industry peers and industry average to know the overall scenario. Let's say, company A has a debt of Rs. 10 lakhs and shareholders' equity of 4 lakh rupees. So, the DA ratio would be 2.5, 10 quarters. On the other hand, company B has a debt of Rs. 8 lakhs and shareholders' equity of Rs. 10 lakhs, then the DA ratio would stand at 0.8, 8/10, which is much better than its peer company A. 6. Return on equity, ROE. Return on equity ratio measures a company's profitability with respect to its equity. It tells us how efficiently a company is using its shareholders' equity fund to generate profits. It is calculated by dividing net income by shareholders' equity.